Hi, I'm Kison Patel with Fundology. Today I'm here with Alan Mayer, Managing Director of Green Manning and Bunch, a boutique investment bank based out of Denver, Colorado. How are you today, Alan?
Good, Ethan. How are you?
Doing very well. So I heard you guys closed on a recent manufacturing deal and want to learn a little bit more about that.
Yeah, no, I appreciate that. Yeah, we just closed. It was about 30 days ago that we closed a nice manufacturing deal. They were a plastic injection molding business based in Longmont, Colorado, which is a suburb just north of Denver. They had been around for about 15 years and whatnot and developed kind of some unique technology and applications for their plastic injection molding and tool making business. And what was kind of interesting about this transaction is they were approached by a public company acquired that was a metal injection molding business. And one of the things that we worked with in terms of doing this transaction was we were prepared to go to a full broad process out in the marketplace, but were able to convince the strategic acquirer to come in and buy the business with what we viewed to be top dollar, where we never actually went to a broader market process.
Okay, so you were working on the sell side on this transaction, and then I guess if you can get a little bit more background on our client, was it somebody you worked with prior, or how did you source into it?
No, it's somebody that we had not worked with prior. It was actually an introduction from a lawyer in Boulder, Colorado. And interestingly enough, the lawyer did not have them as a client either. So we really kind of jointly went and approached them and said, here's what a professional process would look like in terms of a sell side exit. There were four different shareholders all looking for an exit. And so we went and sort of almost jointly approached them, the lawyer and Green Manning and Bunch, and ultimately they did hire us. It was a competitive process like they all are. They were talking to two or three other firms. One was kind of a national firm that would be a very small transaction for, and one was a couple of smaller, more business brokers type. And I think we were kind of the right fit for them, as was the lawyer.
Okay, great. Now, so you're working with this firm. You get the now. Did you sign an engagement letter after they got this offer from a public entity?
No, we had signed the engagement letter and they were approached by the general manager of the metal injection molding plant. There was no formal offer. It was just a lot of conversation between the business owner and the general manager of the acquirer. So I think they had an inkling that they wanted to do a deal, but there was nothing specific. So we got signed up, actually did a full valuation work to say we think your valuation is sort of in this range. If we could get that buyer at the high end of the range, would you be willing to do a deal without going to a larger market process? They said yes. And then we went and approached the strategic acquirer and said, hey, we're Green Manning and Bunch, middle market investment banking firm, like to talk to you about potentially acquiring this business. We're giving you kind of a preemptive offer before we go out to a larger market process.
And then, so you never did take it to the market.
Never did take it. We have a nice, pretty book, all written and ready to go, but we never sent it to anybody except for the one party that we talked to.
And then, how was the negotiations on the deal?
Well, the negotiations were good. Clearly, there was. I mean, sometimes in this industry we talk about strategic acquirers and we forget the word strategic. There was a very strategic reason why this business wanted to buy our client. They were a small publicly traded company. They had a couple of small businesses. The combination of the metal injection molding and the plastic injection molding really made a fit. There was great customer synergy, cost and operational synergy, so they really did want this business. But the age-old issue for us was, can we make sure that they're willing to do what we view to be an attractive market deal, or are they going to try and retrade the deal towards the back end of the process, knowing that we didn't have a backup offer because we hadn't gone to market? So that was kind of the tenor of the negotiations. I will tell you, the buyer was very good to deal with. They maintained their word because there was so much strategic reason for them to do it. But we were pretty clear that, look, if you're unwilling or unable to get to what we viewed to be the right price and the right terms, We were prepared to put this on pause and go to a process, even though that was going to take us much longer.
Now, did you present an offer to them, or did you present a proposed price, or did they come out with something first?
We did not. What we prepared for them was really almost a mini version of our typical confidential memorandum with some financial information that they then asked for us to refine. And we told them, we need for you to get to this price or around this price based upon that information and then provide us with an offer. And as it turned out, they then did provide us with an offer that was a little bit in excess of that price.
So where did you start off with for a price, and where did you end up at?
Well, really, where we started, where their offer was and where we ended up was exactly the price that we had indicated first. And what we did it was based on a multiple. We told them that we had told our client that the multiple range was roughly 5 to 6.5 times, and that they needed to get to kind of the 6.5 times figure to maintain our interest in doing this kind of preemptive offer. And at the end of the day, what they offered was the exact price that we ended up doing the transaction at.
And what was the multiplier that you guys ended up with?
Really about 6.5 times. And one of the things that we did in this process, and it was really ongoing at the same time, was we went to them with some financial information based on reviewed financials. We knew that the reviewed financials may not be enough. So we hired an accounting firm to do a quality of earnings assessment in advance of them finalizing their offer. Once they got that Q of E report, they went ahead and put in their final offer and then hired their own set of accountants to come review our accountant's Q of E report. So it really, you had two different firms assessing what the ultimate EBITDA was, always with the understanding that we needed to get to the top end of the multiple range.
Okay. And then after you get the price agreed on, attorneys draw up a contract. What was anything interesting happened during due diligence?
Well, there's always interesting things, particularly, look, we deal with relatively small businesses. These are, middle market or lower middle market, depending upon how you frame it. Most of our businesses are kind of 20 to 100 million of revenue. This was certainly sub $50 million in revenue, and kind of $3 to $15 million of EBITDA. This one was around $5 million of EBITDA. So these are relatively small companies. The controlling owner's wife was the controller of the company. There was not a deep management team. There's always concerns about confidentiality. So in terms of getting information, getting customer contracts, things of that nature are always difficult. So the negotiations went relatively smoothly, but we had one particular customer contract, and this customer was roughly 50% of the business of our client, and certainly the buyer wanted to make sure that that customer was going to move forward with continuing the same level of sales once the acquisition occurred. So there was a lot of very tenuous conversations as between the seller, the buyer, and the largest customer. That was probably the biggest piece of the negotiation that we had to manage around.
Great. So what else would you say were the biggest challenges with that transaction, other than that issue?
Well, I think really the biggest challenge at that point was this was a public company acquirer. We had pressed them on time. We gave them a 60-day exclusivity period in the LOI. They had assured us that they could get done within that exclusivity period. We said, absolutely, we're going to give you those full 60 days. We'll do whatever we can from a due diligence perspective to help you during that 60-day period. But once that 60-day period ran, we were going to go to market. And so it really came down where there was just a few days left in that exclusivity period, and they being the buyer, had not yet cut a transaction with this largest customer. And there was some tenuousness about that before we ultimately closed the deal. As it turned out, they ended up closing the deal within that 60-day time frame by just a couple of days.
So backing up a little bit, from the time you signed your engagement letter with your client, how long did it take before you got the signed agreement with you?
This was about 4.5 months. We got the engagement letter signed. We then prepared some preliminary information. We talked with the potential buyer for about 60 days. One thing that I will mention here, this LOI had a little more teeth to it than the majority of the LOIs that we're seeing. This was a very heavily negotiated LOI. We gave them a lot of advanced due diligence so that they couldn't come back later and say, well, we didn't know about that. We didn't know about this and whatnot. So it probably took us a full 60 days to negotiate the LOI. Once we got the LOI and then the 60-day exclusivity, that I think translates into about a 4.5-month process, which, look, is a great transaction both for the seller and for Green Man and Bunch, by the way, because the majority of our transactions are taking, when we're going to a full, broad process, are taking much longer, anywhere between 8 and 10 months, sometimes up to a year.
Now, how about the due diligence period?
The due diligence was all conducted within that 60-day exclusivity period from the time of the LOI to the time through the drafting of the contract and closing. And we used a standard data room where we uploaded whatever information we could. We had, as I mentioned, the lawyer that helped us on the transaction, the accounting firm that helped us on the transaction, and the buyer had their lawyers and their accounting firm all deeply embedded in the data room.
Very good. Were there any other technologies you used to manage the transaction?
No, that was really pretty straightforward. It was nice that we just had to manage the one party and all of this, so there was not a lot of other technology that we had used.
Very good. How'd the closing go?
The closing went good. There were a couple of moments of concern where at the tail end there was a little bit of conversation again at the 11th hour about price. There was a little bit of conversation at the tail end about some typical issues, escrow, length of escrow. There was a lease that had to be assumed by the buyer, and we had a little bit of the tail end negotiations over the lease. We couldn't get an assignment of a certain couple of contracts. Typical kind of stuff where at the tail end there's a lot of gnashing of teeth. But at the end of the day, I think it was our ability to say, look, guys, we've told you all along this is the transaction. You have this 60-day period. If you're unwilling or unable to hit that, we're going to market. And I think that pressure ultimately had them close the transaction in the time that we asserted them.
Great, Alan. Now, were there any other aftermaths after post-transaction?
No, it actually has gone pretty smoothly. As I mentioned, there were 4 shareholders. Most of them wanted to, in effect, ride off into the sunset. And so they each gave their kind of 6-month transitionary period. We did have a closing dinner with them. They all said that the transition was going well. They're actually kind of enjoying it more than they thought they might have otherwise. So the relationship between the buyer and the seller are working out very well. So far, the business seems to be performing well. So I think the buyer's happy. From what we can gather in a relatively short time frame, obviously. And one of the things that I think we're going to try and do now, given this transaction, is try and market to other similarly situated, similarly sized plastic injection molding businesses and see if we can't create a little sub-niche specialty in that area.
Very good. Were there any other opportunities that maybe has sprung from this particular transaction?
Not yet. We're in the process of preparing some mailers that we're going to then go do out and contact lists, marketing lists to other similarly situated businesses. So nothing yet. The public company did issue a press release. We issued a press release. We've gotten lots of congratulations. It's always good to know that deals are getting closed, but nothing specific yet.
Very good. How about any key takeaways from this particular transactions or lessons learned?
Well, this is the one thing that I wanted to mention to you. Our sense is that sellers are getting more and more skeptical of broad processes. Maybe we're coming full circle back where you're going to actually start, and investment banks, and certainly boutique investment banks like ours, are going to start to do maybe more targeted processes, either through a preemptive offer, just like the one we did here, or a smaller process. What I mean by event driven is I've talked to a lot of prospects of ours that are like, you know what, Alan, I'm actually enjoying running the business. If someone were to come along and offer me X, I would probably consider that pretty carefully, but I'm not committed to going forward with a process to see if someone will come to us with X. So if we can get people that are relatively interested and then maybe introduce it to a few strategic acquirers that we know, or introduce it to a few private equity firms that we know and respect and maybe have a relevant portfolio holding company, I think those kinds of events are going to be the ones that drive transactions. Certainly, you've always had the events of, I hate to call them the triple Ds, death, divorce, and disease. Those always drive transactions, but we're trying to create events that will show our clients and prospects that you can get a transaction done without maybe doing what they've all feared, which is sort of this 300 or 400 buyer list process, because particularly for small middle market businesses, they are very concerned about the time factor, they're very concerned about the distraction factor, and they're very, very concerned about the issues around confidentiality if we're sending this out to 200 or 300 parties. They like the very targeted processes. That's happened to us in a couple of other transactions recently. So I think we're kind of shifting our thought that maybe targeted process may be a better way to go for some of these lower middle market sellers.
Okay, that makes sense. Now, what are your thoughts on these private marketplaces that are popping up online?
In terms of
Utilizing those for the marketing process. Have you
well,
guys?
I think anything that adds to efficiency, ability to get to relevant buyers, ability to do it in a quick and efficient manner are going to be helpful. I mean, look, let's face it. The sale of a lower middle market private business has been the most inefficient process. Real estate's kind of figured it out and made their processes in terms of selling of institutional commercial real estate better. I think private businesses need to do the same thing. So I think these marketplaces are only going to help and add efficiency.
Okay, would you still utilize a similar process where you're keeping it more very targeted versus having that more broader exposure?
I think it really depends on the situation, and really it depends on the mentality of the seller. We have some owners that are like, bring it on, take it to 300-400 people. I want to take it to everyone I can so I can make sure that I'm getting absolutely the last dollar on the table. And we have certain other clients that are very scared and intimidated of that process. And I think we need to respect that. And so and I think it's just a case-by-case basis.
Very good, Alan. I appreciate you taking the time sharing your story with us. I want to finish off and just learn a little bit about what type of deals you're looking for.
Great. No, I appreciate that. Green Manning and Bunch is a middle market investment banking firm. We've been around for 26 years now, so I think that probably makes us one of the oldest in the industry. We're based in Denver, but we're looking at doing deals nationally. As I mentioned, most of our transactions are really kind of $3 million of EBITDA to $15 million of EBITDA. So if you roughly translate that, that's probably enterprise value of $15 million to $100+ million of enterprise value. We have two basic industry verticals. One is manufacturing and industrial services, and one is healthcare. We've tried not to be all things to all people because we do believe that industry expertise is a key differentiator. So we're doing lots of manufacturing, industrial service, value-added distribution, aerospace and defense, transportation and logistics. And within healthcare, we're doing a lot of healthcare manufacturing and healthcare IT transactions.
Thanks, Alan. Again, I appreciate the time and look forward to hearing about more deals from you.
Great. Thanks very much. I appreciate it as well.